everyone. Thank you for joining us today. We're going to have a great webinar with Charlene Werther and Sean Britt joining us today from Nationwide. As you have questions, please type your questions in the question box on your control panel at the bottom on the right side of your screen. We'll answer all of the questions at the end of the presentation. After the webinar, feel free to give me a call to receive a copy of today's webinar and to answer any additional questions we don't get to. Thanks again for joining us today. Sean, go ahead and take it away.
Okay, thank you. And thank you all for joining us today. And we're going to be talking today about the differences between long-term care writers and chronic illness writers. This has been a subject near and dear to my heart for many, many years. There's so much confusion around these. And I hope at the end of the presentation today that you will feel a little bit more confident in how you're presenting these different products to your clients. So to get started, I won't go through the agenda, but we have a lot to talk about, and we're just going to go ahead and get into it. So if you think about the traditional long-term care industry right now, they just do not have a command of the long-term care market anymore like they did 20 years ago. We've seen interest rates decline. I mean, those of you who've been around quite a while, I'm one of those people. We've seen interest rates just, I can't even believe the difference in interest rates from 20 years ago. And another thing they didn't expect was lapse rates being so low. They priced these policies originally at lapse rates that would mimic life insurance, but which is 7 to 9%. But long-term care, while it's the hardest product to sell, it's the stickiest business. So very few people give up the policies, about 1%. And then they started out, they weren't gender-based pricing, and it came to light, a little late, that females were nearly twice as likely to file a claim than a man and have longer claims. In the meantime, we've also seen the elimination of most single pay and short pay policies from the traditional industry. And so new policies are being priced today with lessons earned, but they still don't offer guarantees. And because of all of this, you're going to see that the combo market has really commanded the space now. So it's interesting to note, back in 2000, 750,000 traditional long-term care policies were sold. In 2018, it was 56,000. So, I mean, we're talking over a 90% decline in sales in an 18-year period of time. Now, if you look at the combo sales in 2018, it was 461,000 policies sold. If you add that to 56,000, we're still not at the 750 of policies that were sold in 2000. So while the shift has changed to what kind of policies we're selling, we're not selling as many as we did once upon a time. And I think part of that is the confusion in the market. So we're hopefully going to clear up some of that today. So the other alternatives, which is what resulted in combo products, have changed how we're doing business now in relation to long-term care. Now, these riders have existed for a long-term care, but in the early days, they weren't well marketed. Trust me, I was there in the early days, and I was one of the few people that took it seriously. But today, people see this, advisors and clients alike see these as a welcome solution to how to deal with a long-term care event. And the reasons for that is a long-term care rider on life insurance can transition from family or income protection to long-term care coverage, meaning we have more of a reason to buy a permanent policy instead of term insurance because we have two ways to use it now. We've also eliminated the use it or lose it objection that is had by traditional policies. And then there's still a multitude of options for premium payment schedules, from single pay to pay for the rest of your life and anything in between. So you can really customize a payment schedule. And then we can offer guarantees on combo products. Premiums and long-term care benefits can be guaranteed. And thus, that is why you see that shift from traditional sales to 89% of sales today being the combo products. But with all of that product development has also come some confusion. And so we want to understand the differences. So the first thing that's going to, and the most important thing that's going to define these differences is the rider classification based on tax qualified status. And that's going to determine how this rider can be marketed and the selling requirements, how the rider will be charged for, whether or not it'll be underwritten, the type of claim it will pay, and the effect it's going to have on the policy death benefit or the total amount of death benefit that's available to be paid. Now, one of the things I like to sort of clear up in the beginning is the confusion with terminology. Because, you know, one of my pet peeves about the industry is they allowed chronic illness riders to be called chronic illness riders, because all that has done is create confusion. They should have been forced to use another name, and here's why. The term chronic illness refers to a state of health, and that state of health is required whether you file a claim for a traditional long-term care policy, a long-term care rider, or a chronic illness rider. The definition of chronic illness, in other words, that state of health, is that a US licensed healthcare practitioner has certified you to either be cognitively impaired, such as Alzheimer's or dementia, or that you have two activities of daily living impaired for at least 90 days. So it can potentially be temporary. I'll get to that in a minute. But it's bathing, dressing, continence, eating, toileting, and transferring. Now, the long-term care riders must, not just will, must pay both temporary and permanent claims. And a temporary claim will be something that's more than 90 days, but not forever. Chronic illness riders, however, could be limited to permanent claims. And the new regulations are what added to that confusion. So under the old regulations, a chronic illness rider had to be likely permanent. In other words, the doctor had to certify the condition was likely to last the rest of the insured's life. But in 2014, they decided to change the regulation for chronic illness riders to where the insurers could have the option of paying a temporary claim. They weren't forced to. They could still require permanency, and many still do, but it was an option that they could offer. And most importantly, the new rules were not grandfathered onto old policies. That was one of the biggest confusions when this happened. Thus, you see why I say I wish they would have called chronic illness riders something different, because everything is so tied to the definition of chronic illness to go on claim, yet a chronic illness rider is a totally different entity. Now, all long-term care riders, as I said before, they are required to pay a claim. If it's going to last 90 days or more, a long-term care rider has to pay it, even if you're going to get well. So tax qualified long-term care riders, what that means is that they're receiving favorable tax treatment under 7702B. There is a rare form, I'm not going to go into a lot of detail, and it's mostly on whole life policies. There's a rare form of long-term care rider that is using 101G along with NAIC long-term care model regulations. Again, it's a handful of whole life companies, but they can still call their rider long-term care. These can be marketed as a qualified long-term care contract. They will cover temporary and permanent claims. The majority of states do have a long-term care CE requirement. Some states have a separate health license separated out of the life license. When I got my licenses in Ohio, they were combined. If you got a life license, you automatically were getting your health license. So depending on the state, you may have to get that separate health license. The riders are underwritten and charged for. So the relationship of the death benefit to the long-term care benefit is a dollar for dollar reduction, and this is a good thing. And I'm going to show you examples in a minute so you understand when I talk about math, I promise I'm going to show you the math. And the long-term care benefits are determined at policy issue, and you're going to receive 100% regardless of when that claim takes place. In other words, whatever it is you bought is what you're going to get. This is important to understand because not all writers work this way. So what differentiates long-term care writers? Well, basically, the only difference with long-term care writers is how they pay benefits. So you have reimbursement plans, you have your basic indemnity plan, and your cash indemnity plan. That's your difference. So an indemnity plan, only the actual costs covered under the policy will be reimbursed. Bills and receipts have to be submitted to determine how much will be reimbursed. And while some companies will work directly and do third-party billing, they'll work directly with a provider. Keep in mind, not all providers want to do this. They want to bill the client directly. So you may or may not be able to do that third-party billing. There are benefit limitations, so non-qualifying service will have to be paid out of pocket. And licensed providers are generally required. They are easing up a little bit, and some reimbursement plans are offering a little bit of family care, like a limit of 1 year, for example. A vanilla indemnity policy is where you're going to receive the full long-term care benefit paid to the owner every month. Some insurers are going to require that you prove you had at least one licensed service. They don't require all of your care is provided by a licensed provider. They want to make sure, though, that one person is licensed and they see it as oversight, and some of the carriers will make you prove that, others will not. And the unused benefits can be used without restriction. So you're going to get all of the money, but depending on your carrier, you may have to show that you're using a licensed provider. Cash indemnity is different in that you also get the full monthly benefit, but no bills or receipts are needed to collect benefits ever. You may have to show them when you're justifying your claim, but to get your monthly benefit, you never show the bills and receipts. You can use the money 100% without any restrictions, including informal or family caregivers. In fact, just a side note, at Nationwide, 42% of our claims are 100% informal care because we have cash indemnity benefits. And so again, the insurer places no restrictions on how those benefits are used. Now, chronic illness writers, they receive federal favorable tax treatment under 101G, but they are strictly prohibited from being marketed as long-term care. Again, as we mentioned earlier, the Interstate Compact, and for those of you who don't know what the Interstate Compact is, it's a collection of 38 states who have agreed to agree on how long-term care and life insurance and annuity products are implemented. And it depends what product it is, how many people are in the compact. For example, for life insurance, there's 40 states in the compact, but for long-term care, there's only 38. So 38 states have identical filings. And then those other 12 we have to file independently. So the Interstate Compact allows these products to cover temporary claims, but some states, if for instance, New York and Florida are separately filed states, they may not. So again, you always have to read the contract. There's currently no CE requirements for these. I've always said if anybody needs to do the CE, it's the people selling these writers because there's so much that isn't understood, especially about one particular type. So the actual methods are going to vary, and some are going to use the dollar for dollar method. Those are going to look the closest to a long-term care writer. But the ones that really should be taking CE benefits are the people selling discount method writers, because the discount method is so confusing and so misunderstood and so unintentionally missold. So what differentiates a chronic illness writer? Well, basically the underwriting and benefit formulation are the main differentiators. So you have a certain group of chronic illness writers that actually charge for it along the way and underwrite for the chronic illness risk. So you're going to find monthly deductions taken from the policy, and they will be underwritten for morbidity, just like a long-term care writer. The chronic illness rider benefit will be determined at policy issue, and 100% of the amount is paid regardless of when the claim takes place. That should not say LTC claim, it should say chronic illness claim, assuming no withdrawals or loans. So these look and feel like a long-term care rider, but you're going to find out later why they are not. Then you have your discounted benefit riders. There's no underwriting, but they are often sold as free, and they are not free. They are charged for at time of claim. The benefits are going to be discounted based on actuary factors. So the benefit will be different based on a formula, and I'm going to go over that in a minute. There's no charge if it's never used, and you can never tell a client ahead of time how much they're going to get. Now, I wrote this presentation prior to Nationwide coming out with their version of a discount rider. I will briefly mention that in a minute, why it's different, but for the most part, what I'm telling you today applies to all other companies. So the dollar for dollar method is the method that is used by long-term care writers and chronic illness writers that fully underwrite and fully charge for the rider. Now I'm going to use a 2% month example because that's the most common benefit people get is 2% a month for 50 months. So if you look at this policy, the client bought a $400,000 policy. And I'm not going to go through this whole chart because that would be dreadful. But as you can see, it doesn't matter when you start or stop the long-term care claim, and when you die, you're going to collect $400,000. You bought a $400,000 policy, you're going to get $400,000 out of the policy. It doesn't matter what configuration you come up with between the LTC benefits and the death benefit, it will add up to $400,000. This is what your client expects to get, and this is what they will get. Now, the discount method, which all companies, this particular method is one used by everyone except Nationwide. With this one, there's no underwriting, and it's available to all. The no charge, again, does not equate to free, and the death benefit is discounted at the time of acceleration. What they do is, I'm showing a policy here where they had a $500,000 policy with $50,000 of cash value. The discount interest rate is 7%, and they're going to take 20% of the death benefit. So they ask for $100,000. But if they're a male, they're only going to get $65,000 and change. And if they're a female, they're only going to get $56,000 and change. So why did the male get more? Because he was supposed to die sooner, so they can afford to pay him more. And to get that $65,000, he's going to sacrifice nearly $35,000 in death benefit. That's death benefit that will never be paid to anybody. The company gets to keep that. They don't have to pay it. And for the female at age 70, she's giving up over $43,000 in death benefit. That is the charge. So you do that for a few years, that's a lot of lost death benefit that you were counting on, whether it's for your family, for yourself, etc. Now, the difference between Nationwide's discounted chronic illness rider and this formula is that we use a reduction factor instead of a discount interest rate, and we have a guaranteed bottom line. I'm not going to go into that today. In fact, with some of you have already heard the story. And again, discount chronic illness riders are not planning tools, they're emergency tools. No one should use this to plan. This is for someone who has no other recourse to get money. And maybe they were declined for a long-term care rider. But they should always try to use money from someplace else and let this death benefit pay in full. Don't give up those dollars. I don't care which company it is, including ours. Do not give up those dollars unless you have no other way to get money. Now, this is the lien method with interest. This is seldom used anymore, so I'm not going to go into a lot of detail. It sort of has a formula that looks and feels like a terminal illness benefit, but the difference is they put a lien on the policy. So your remaining death benefit is the collateral to pay the debt off. And if you're on claim too long, you'll eat through the entire death benefit and nothing will be left to pay. If you die quickly, the charge isn't too bad. Again, this method is sort of hard for people to understand. People just stopped using it. So there's only a company or two left that still has this. Now, as for tax considerations, let's say you have two policies. You have a long-term care policy of whatever kind and a chronic illness benefit. It doesn't matter. They're all going to be added together for the formula. So cumulative of all benefits collected, whether it's long-term care or chronic illness, you can receive cumulatively tax-free the greater of the HIPAA per diem in the year of claim or your actual costs incurred. Now, you can choose to take less to help avoid taxation. There's nothing wrong with that. And with long-term care riders and your chronic illness riders on life insurance, there's nothing to lose by leaving it in the policy. They're one bucket solutions. So being that they're one bucket solutions, there's nothing to lose. So take less if you're going to end up in a taxable event. Now, here's where the importance of consumer protections come in and how it differentiates long-term care from any type of long-term care or chronic illness rider, because long-term care riders have a higher standard of policy protections. And it's really important to tie this to Alzheimer's disease. So number one, it's the number one cause of claims over the age of 65. And deaths from Alzheimer's has increased 145% since the year 2000. And 1 in 3 seniors will die with Alzheimer's or another dementia. Now, this is important. This really sets up the value of these consumer protections I'm going to talk about. So first of all, long-term care specific consumer protections are required on all traditional policies as well as any combo policy. So any long-term care product, whether it's traditional, on life insurance, on an annuity, has to have these protections, but they are not required on a chronic illness rider. And most companies offer none of them. A few companies offer limited versions of them. The consumer protections are a long list. Most of them, I mean, I'm just going to be honest, most of them are like, okay, fine, but is it a big deal? No. But there are some that are a really big deal. And the 3 I'm going to talk about today is the lapse protection while on claim, the reinstatement provision with no underwriting, and extension of benefits provision. Now, don't confuse this with the extension of benefits bucket number. This is not bucket number 2 of a hybrid policy. We're talking about a provision called extension of benefits. So it is a different thing we're going to talk about. So lapse protection while on claim. So a long-term care rider must offer the same lapse protection as a standalone policy. So these benefits cannot be lapsed while the insured is on claim in a facility and receiving LTC benefits. Any remaining death benefit not accelerated at the time of death is not protected. So that's up to the company. How the remaining death benefit is treated, again, you want to read the contract to see if they protect all of it or just the part covered that's covering long-term care. They can choose to protect none, some, or all of the death benefit. At Nationwide, our long-term care rider 2 and survivorship rider will protect any amount that has long-term care attached to it. So if you have a $500,000 policy with a $500,000 LTC rider, your full $500,000 is protected. And we also will protect it no matter what type of claim you're receiving. So that's, again, another thing you have to check for the company. Are they going to just stick with the regulation or will they expand on the regulation? We will cover any type of care. If you're on claim and receiving benefits from us, regardless of why, you're covered. Chronic illness riders are not required to have this feature. To my knowledge, only one chronic illness company does. And the premium can be required while on claim. And again, most of these companies will require you to keep paying premium while you're receiving chronic illness benefits. But with a long-term care product, you can, they can't lapse it. So the reinstatement provision. So what that means is if for some reason you just, usually this is dementia, you have not been paying your premium and your policy lapses, you have a 5-month reinstatement window, meaning you have 5 months to show there was a good reason. In other words, you can't stop paying premium, let your policy lapse because you thought you weren't going to need long-term care and then go, oops, I was wrong, I want the policy back. That's not a good reason. A good reason is you had Alzheimer's and don't remember who Nationwide or whoever the insurance company is, you don't even remember that name and you think it's junk mail and you're throwing it away. Things like that. But you have 5 months to get your policy reinstated without evidence of insurability. Now, this is one of my favorite features, and here's why. If you have a life insurance policy with a long-term care rider, and you have a situation where you need to use this, the only way to reinstate your LTC benefits back to where they were is to reinstate the life insurance policy back to where it was. So you get where I'm coming with this? This is going, if you have a long-term care rider on your base policy has to go by the long-term care standard, not the normal life insurance standard of requiring evidence of insurability. You have a rider on that base life insurance policy, a long-term care rider, they have to let you reinstate the whole thing without evidence of insurability. That to me is priceless. And that's why that's my favorite consumer protection. Chronic illness riders, I have not read a contract yet. I'm not saying it doesn't exist somewhere. I have not found one company yet that will offer what a long-term care rider does. Again, I have not read them all, so I could have missed it, but generally they're going to require evidence of insurability. So if you have Alzheimer's and your policy lapsed, you're not getting any of it back because they can't, you can't issue a policy to someone with dementia. If you have ADLs impaired, you might get the base policy back, but you're not going to get your chronic illness rider back. So that chronic illness rider is going to remain lapsed, even if you do manage to get your base policy back. Now, the extension of benefits provision, this is also unique. And again, this is separate. This has nothing to do with hybrids. And again, you've got to show a good reason why you couldn't pay premium. But it leaves the door open indefinitely to capture LTC benefits the insured would have qualified for while the policy was in force. So what this means is, and I'm going to give you an example of how these benefits work using a story that happened to us at Nationwide. So there was this woman who bought a VUL policy, one of our early VULs. She bought one of the first ones. She put a long-term care rider on it. She paid premium for a few years, and then inadvertently she stopped. But the market was doing very well at the time, and so her policy kept going. And then one day we get a phone call from her 2 daughters. And it turned out that she had had dementia for the last 2 years. They had been trying to keep her in her house. It was getting painful for the daughters. They just couldn't handle it anymore and decided they had to put her in a home. And they were cleaning her house out, ready to sell it. And were wondering how long they were going to have money to pay for this because mom didn't have a lot. And it was, a nice place for the type of situation the mom was in. But in cleaning out the house, they found a policy that said long-term care rider. So they called us to see what it was. Well, the real story is that policy was hanging on by a thread. I mean, literally a thread. And it was such a thin thread. We told them, you've got to get this paperwork in very, very quickly, or you're going to have to pay a couple of months premium to keep it going. Though, we probably would have been fine. We would have just used the reinstatement provision anyway. We just would have had to go through more hassles. But anyway, we told them, we'll get this claim started. We not only got her on claim, we paid her for the 2 years that she should have gotten money. So in some states, you're allowed to even go back and pay the back benefits. Some states don't allow it, but anything that you are entitled to going forward, you can get. But let's imagine that these girls didn't find this policy for 18 months after the policy had lapsed. We still would have paid because she's been in a state of dementia for 2 years, and 2 years before the policy was still in force. Therefore, they could go back and show medical records that if she had just remembered she had the policy, she would have filed for the claim. And once on claim, it can't lapse. Therefore, we go back and we will pay the benefits. Now, your death benefit will no longer be in force. So whatever is left, that will not be given to a beneficiary because the death benefit is gone. But if you live long enough to collect all the LTC benefits, then you will. And this, this again, it's a consumer protection that you are entitled to when you buy a long-term care rider. Chronic illness riders do not have this feature. Once the policy is lapsed, it's over. Benefits cannot be recaptured. No death benefit is paid. It's all done. Now, I'm not going to go through all of this, but I just want you to know that you're all going to receive this presentation today. And what I did do was put together a chart that would show you summarize the differences that we talked about today. And you can take this, I've seen people pin them on the wall of their cubicle, put them in a notebook, but use these charts for handy references. So just to summarize, and we'll open it up for questions if we have time, but you want to make sure that your client understands the triggering conditions that are covered under the policy. Does the claim have to be permanent, or can you pay a temporary claim? And I've known several people who went on temporary long-term care claims. This does happen. And how are your rider benefits calculated? Is it going to be a dollar for dollar benefit, or is it somehow discounted on the back end and nobody told you that? You want to know that up front. And how are they going to be paid? Are you going to have to reimburse your expenses, or do you just get cash in hand to do what you need to do? Are the benefits going to be protected from lapse while on claim? This is extremely important. And what about if you mess up and lapse the policy due to some dementia issues? Can you get your policy reinstated? Or can you even go back farther and get those unintentional lapse extension of benefits? These are all really important questions. These are why I am a firm believer that when you are planning for long-term care, you want to plan with a long-term care product, whether it's a traditional long-term care product, a long-term care rider on life insurance, or a linked benefit hybrid or policy. By the way, all the hybrids are long-term care. There is no such thing as a hybrid that is not long-term care. So any of the companies selling the linked benefit policies, all you have to worry about is how they're paying benefits. They are all long-term care. But you want to stick with true long-term care products, because with that, you get the full cover of protection. You get the most comprehensive protection you can offer a client. So I'm going to go ahead and open it up for questions. While we're getting that opened up, you can see the slide here, how to contact the folks at Art Jetter. They're wonderful people who can really help you, and they know all this stuff, so they can give you the guidance you need.
Definitely. Well, yeah, thank you everyone for joining us again, and thank you, Sean, for all the great information on long-term care versus chronic illness riders. I do have a couple questions here. And again, if you have any questions over all of this, I know it was a lot, but very detailed, very good info. You can put your questions in the question box on the control panel at the bottom right side of your screen. First question I do have here is, what is the difference between the indemnity versus cash indemnity? I know we kind of breezed over it, but
I know that's hard for people to comprehend. The main difference is a basic indemnity policy. I'm going to see if I can get back up that slide. A basic indemnity policy may have strings attached. You're going to get the full benefit amount, but you may have to work a little harder to get it. So if you have a $6,000 a month benefit, they'll pay you $6,000 a month, but you have to use some level of license provider. Now, some companies only make you prove that once a year during recertification. Other companies will make you prove it once a month to get the money. So again, you have to read the contract. But any amount that's not used for licensed care can be used any way you want. Cash indemnity is different, and you will also get that full monthly amount. So a $6,000 benefit will pay $6,000, but there's no bills or receipts ever to prove you're using a licensed service. There's no restrictions. You don't have to use a licensed service. You can use 100% informal or family care, or you can do crazy. I mean, whatever you want to do, whatever it is. If you have some very customized plan you want to put together for yourself, you can do that. There's no restrictions at all. It's literally cash in hand. And as I said earlier, 42% of the claims at Nationwide, we are a cash indemnity company. Everything we sell is cash indemnity, and 42% of our claims are pure 100% unlicensed care. So it makes, when people have choices, and it doesn't mean they're necessarily using family. We have one case on the books where it's the two ladies from the church. That's what these two ladies do. They're not licensed caregivers, but they're very good at what they do. The people in the congregation trust them, trust their integrity. And so that's what these people, that's what they do for a living. And most of their clientele, a lot of their clientele either come from church members or references by church members. They're not family members, but they're unlicensed, and the money can be used to pay them too. So the point is, you can do whatever you want when you have a cash benefit. So that's the difference. It's minor, but it's big at the same time.
perfect. Well, that looks like all the real questions over the presentation we've got right now. And we're just a little shy of the 45-minute mark, so we can kind of wrap this up here. I don't know if you have any other closing thoughts here, Sean or Charlene.
Well, I'll just close by saying that Nationwide has a full suite of long-term care solutions. We have Long-Term Care Writer 2 that you can add to almost all of our life insurance products that pays cash indemnity benefits. We also have a cash indemnity long-term care writer on our survivorship IUL. And then we have Care Matters, which is our linked benefit, or as some people call them, hybrid policy, also paying cash indemnity benefits. So we have that full suite of long-term care solutions that can be added to a multitude of types of policies, so that you can buy a base insurance policy that fits your client's immediate needs, but add a long-term care writer to fit their long-term care needs later in life.
Definitely. Well, yeah. Well, again, thank you everyone for joining us today. Thank you, Sean and Charlene. Please give us a call or send us an email to life@jetter.com if you have any additional questions, or if you'd like to see some illustrations from Nationwide. Thanks again, everyone, and have a great day.
Thank you so much.
Thanks, Alex. Thanks, Sean.